Um, Sadaf Said, CFO of Muthoot Microfinance, also joins us, and let's understand from him that what his understanding of the stress in the MFI space is. Mr. Said, good morning. Thank you for joining us. It looks like a big hole, so to speak, for the MFI space. All the data points are indicating that things may not improve for 3, 4, even 5 quarters. What is your understanding?
Good morning, Nikunj. Thank you for having me here. I think my estimates are not as pessimistic. If I look at, I think the impacted area, largely if you look at the impacted area is north, which is like UP, Bihar, and certain districts. Punjab was impacted before the elections because of the Qarz Mukti Abhiyan. Now the collections have started coming in. Usually, such kind of issues last, if you look at empirically, 3 quarters. So we are at the fag end of this. November has already seen some stabilization. December will further see a stabilization, and I think March quarter, which is quarter 4 onwards, I think will start improving. I think I was hearing your co-panelist there. I think the perception that everybody is lending to the same borrower is not as simplistic as it seems. Because if you look at the borrower count itself from 2022 onwards till now, it has increased by 2 crores. So the borrower count before the policy liberalization was 6.5 crore. Today, 8.5 crore households are getting credit from microfinance industry. So I think it's not that. I certainly agree there is a little bit of an over leveraging. But if you look at the sector, the and the product itself, it's a short tenor loan and it unwinds very quickly. So in the last 6 months, when the slowdown or sort of a correction has happened, in itself around 5 to 7% reduction in the outstanding has happened. In March, the overall AUM for the industry was 4.4 trillions, and it is now, as of June, around 4.14 trillion. So around 30,000 crores of unwinding has already happened. And the sector has very responsible self-regulatory system and self-regulatory organization. They have put some guardrails, some guidelines into place. They are taking their effect. So they were introduced in July only. So impact was from August, September onwards. I think that impact would be shown in coming days, and things will definitely improve. And I understand and I accept that there is increase in delinquency. I think there are factors which are linked to rural wages as well as inflation, which is having an impact. Of course, there is over leverage in certain pockets where there is an impact on the portfolio, but things are not as bad. If you look at in our portfolio, still Kerala is still at 98% collection efficiency on time. Tamil Nadu is at around 97% on time. Karnataka is also 97% on time. I think it's a clear distinction between the states where the per capita income is higher. The leverage is not reached to the extent where default is triggered, but states where the per capita income is lower, for example, Bihar, UP, Odisha, Jharkhand, there the stress is being seen. So the industry is responsible. They have already taken initiatives, and the disbursements have slowed down. As the loans unwind, I think the leverage will also unwind and things would be much better. If I can just give you an example and comparison, I think it's not like as bad as COVID. In COVID, the collection efficiency went down in April to almost near zero, almost 2%. And it came back very fast. In September itself, it was around 70 odd percent. And by March, it reached around 96%.
Sure.
And that journey we are already traveled. We are already at around 96%. So things will definitely improve. I think you have to give 1 quarter more.
Sure, Mr. Said, we take that point. You've given us lots to really think about, and you talked about how March will see a bit of a recovery. But since you said in the interim the delinquencies are increasing and the impact of it will be seen in this quarter, any initial assessment that you can give us in terms of the numbers?
So if you look at, I think from the credit cost perspective, it depends upon how the company is managing the portfolio. Definitely, credit costs are likely to increase. We have given a guidance for our portfolio range of around 3 to 3.75%. But I am looking at the trend very confident it would be towards 3%. For different company, it depends upon how their exposure is, because our 50% of the portfolio is in South, which is reasonably better cash flows and income levels. So there the credit cost would be least. I think people who have larger exposure to Bihar and UP might have a little bit higher credit cost. But whatever it may be, the peak of credit cost in this industry has been in COVID, which was in the range of 5 to 5.5%. I don't see it going there. It should be in the range to 3 to 4%. That's
Sure.
what my estimate is.
Okay, and yours will be closer to 3 as you pointed out. But given there is a bit of a moderation in disbursements, any relook at the numbers that you had hinted at the start of the year? And what's been the pace in Q3 so far?
No, we have already revised the guidelines for ourselves. We had projections of around 10 to 12% growth. Previously, we had given a guidance of 25% growth, which was at the beginning of the year. But looking at the circumstances, also evaluating the impact of the guardrails that have been put in place by MFIN and also Sadan, we have revised our guidelines to around 10 to 12% growth. And I think that's quite reasonable, and we can definitely achieve that. We have seen that the disbursements have increased from Q1 to Q2 around 21%. I see disbursements to be flat or slightly upwards in Q3, and March will definitely see a good, healthy disbursements.
So, at the start of the conversation, you said it's oversimplistic to say that all the borrowers are having exposure to or rather all the lenders are having the exposure to the same borrower. Would you have any data to kind of corroborate that, in the sense, within your basket of, let's say, customers, how many of them will have multiple lenders? Would you have that data point, maybe 3 or more or something like that?
Yeah. I think, thank you, Aisha, for asking that question. That's a very, very pertinent question, and that really debunks the theory that everybody is lending to the same lender. If you look at, I'll come to Muthoot a little later, but I can tell you about the industry level. Almost 85% of the borrower either have only one lender or two lenders. That's the whole universe. The 15% of the lender are having maybe 2, 3, 4 lenders or even more. If you look at more than 4 lenders, there are only 6% of the borrowers. And that does not mean that all 6% of those borrowers are delinquent. If you look at, I don't have the delinquency number on that 6%, but I can take an exploration from our numbers. If you look at, we have around 10.6% of our borrower which are having more than 4 lenders, out of which around 14% are 30 plus. So 86% of those borrowers are also paying on time. And if you look at, even if you consider that around 14% will go into a higher delinquency bucket, that translates to 1.4% credit cost. And that's 30 plus. Either by the time it reaches 90 plus, it will be in the range of 1% or below. I think that is what the damage which looks like from over leveraging. And that's what I estimate, because if you look at conventionally, the credit cost has been around 1.5 to 1.7%. Because of this over leveraging, it could go by 100 bips more. So 2.7, 2.8. Well, that's why I'm conservatively giving you a 3% guideline.
Over leveraging is something that you're already built in. We'll let you go, Mr. Saeed, on that note, but